All right. There we go. Hey, good evening, everybody. We are at the top of the hour. Time to start this week's Credit Banking Mastermind. We are so glad that you're here. We also want to give a huge shout out to Mr. CJ Wallace for having us guest star on his Velocity channel on YouTube, where you can get everything and all the information that you need to know about velocity banking, credit banking. Some folks call this tactic sweep strategies. There's a lot of names that this strategy goes by, but tonight we're really just going to be continuing the building on of the foundation that has already been laid. Every single month, we go through an entire cycle of the credit banking process. So we're actually moving towards the end of the credit banking process, and this is really moving into the final advanced strategy sections. So stick tuned with us, though, because you're going to have to hear this stuff several times. And if what you hear tonight is, your first time, remember that, is it next week or the week after that we start fresh again from the beginning? Next week?
Yeah, budget.
Next week, we're starting fresh with budget. So if this is your first attendance here, this is kind of the end of this month's training, which you're going to find so much value in. And then starting next week, we're going to be starting fresh. So you got to make sure that you're here and you don't miss next week. Also, what is credit banking? And how do we continue the pursuit of the lost American dream? Well, really, that's what we are talking about tonight. And let me make sure I can move us forward in here. My name is Ray Fleming, and I am one of the co-founders of Wise Guys and Ties, the experts in personal credit and business credit. Here's our contact information on the screen, 888-524-9273. You can always email us at bizcredit@wiseguysandties.com or go over to wiseguysandties.com. And of course, we're on every social media that there is, from Twitter, Facebook, Instagram, YouTube, wherever you want to find us, we are there. And so we strongly encourage you to participate, both YouTube and in the actual Zoom webinar. We encourage participation, and if you're not quite sure what to do, it's really, there's no such thing as wrong answers. And don't be afraid to put it out there, because if, let's say that your answer is not the most ideal option, it gives everybody an opportunity to understand why that is maybe not the first choice. Because when we get into, which line of credit should we do with this? If you're not quite sure, what's your gut reaction? And then this will help others, because I'm sure they have the similar thought as well. Also, as you are moving forward in the process with us learning about credit banking, you can go over to wiseguysandties/credit-banking. Now, the important thing that you want to understand about the Credit Banking Mastermind is you can actually become a case study that we go over. We don't want any personal information as far as, social security numbers, addresses, nothing like that. But what are your actual numbers as far as limits on accounts, the number of accounts, promotional periods, maybe on credit cards, interest rates, the terms of loans, monthly payment amounts? It is all here in this form for you to actually be able to fill this out. Now, when you do fill out this form, now let me go back. This form is for two different folks. You can either be an example, or if you would like to schedule a free 30-minute consultation, we will want you to have this form filled out as well. It really cuts down on the time that it would require for us to actually pull out this information. That way, we can make the best and highest of effective use of the 30 minutes that we're doing. But so as you fill out this form, all we need is your name, your email, your phone number, so we can actually contact you. And then you must check the boxes here to basically say that you understand that you're participating in a credit banking mastermind. Here's the optional fields, so loan amounts, monthly income, interest rates, and it really allows you to tally up your credit limits and your loan limits. Now, if you have multiple loans, you have multiple credit cards, down in the current situation box, this is where you have the opportunity to then explain your current situation. And what I mentioned earlier, you know, really getting into the limits, the accounts, the number of accounts, promotional periods, the interest rates, the terms, the monthly payments, and all of that beautiful jazz. And that will, oh, and also, before I bring up my partner in doing good, I want you folks to understand that both Joseph and I talk a lot about finances. We talk about tax strategies. We talk about banking. We talk about business. We talk about real estate. One thing I want you to understand, though, when we're on these webinars, we are not practicing any licensing in any specific situation. You know, since we are in a mastermind, these are general, we use general numbers in our trainings, and your specific situation is going to be unique to itself. Now, we have attorneys, we have CPAs, we have financial advisors on our team, and that's really the first step to getting, you know, going down that road is a consultation and working with us. But I want you to understand that you should always make sure that any financial, legal strategy that you're implementing, check with the professionals to make sure that it's working for your specific situation. Now, this handsome fellow that you see on the screen here, like I said, my name is Ray Fleming. Now, this other guy that you see, no, I'm just kidding. My other good-looking buddy of mine, his name is Joseph Smith. Now, you may, don't get him confused with the other Joseph Smith. This guy is actually the guy that helps you develop your finances. And as we are sharing the screen here and moving around, but he comes from a background of just truly helping folks. Played football in college, was in law enforcement, and then also worked for the Department of Economic Security and more specifically, Child Protective Services. This guy just comes from a true heart and a place of servant leadership, and he has really taken it upon himself to really continue the journey of helping folks, and now really branding himself as what we call the money guy, because the hundreds of thousands of folks that he is going to be helping free themselves from their financial bondage. I mean, that's really why I'm proud to call him my partner. So this is the man that we're going to be learning from tonight, Mr. Joseph Smith. So Joseph, come on out and their finances.
Yeah. I got to be host. There we are. All right. Don't you love technology when it works, folks? Didn't Ray do a good job? I really like working with that guy. He's a lot of fun. He's a real firecracker, shoots from the hip. He's our technical AV guy. He's going to be making sure that you're able to hear me, and that we get and we respond to all of your wonderful messages. We do want you to participate. Please make sure you're asking your questions. We'll try to stop as frequently as we can to answer them. And also, we want you to feel very confident when we get into the mastermind phase. It's really meant for us to just bounce ideas off each other. I'm super excited for today. I'm glad to be back, and let's just jump right in. So what are we going to be talking about today? We are going to be talking about, well, all the aspects of credit banking. So far, what was covered was how to make a budget, how to live by a budget, and how to start cash flowing from your budget, because you really can't do credit banking without cash flow. Then after that, we went over the math really behind everything. We looked at how expensive is the amortized interest on loans versus how expensive is the amortized interest on lines of credit. And it's really important to understand the difference between the two. Then last week, Ray did a good job of really taking you through the step-by-step procedure of actual credit banking, where you push your income through your lines of credit, you put your expenses back onto your lines of credit, and then each month putting your income, your paychecks, to pay down those lines of credit. And then using the lines of credit to take huge chunks or out of your loan. So you're transferring highly amortized interest into lower amortized interest, let's say. And what that does is it decreases the total number of payments you have to make. And when you decrease the total number of payments, you decrease the total number of interest. And that has the effect of aggressively paying down the debt, while at the same time, well, it really makes it so that you could pay off a loan in about 1/3 the time. So now that you understand all the nuts and bolts, really this week is where we kind of talk about some advanced areas in credit banking. I think Ray covered a little bit of using a HELOC type of strategy, and we'll talk a little bit more about HELOCs today. But I also want to go over relationship between business credit and credit banking. This is when we really start to take the concept of credit banking in its generic sense, and we begin to accelerate this. Business credit with credit banking. Well, to really help you understand this, we also are going to encounter many pitfalls along the way. There's a lot of people who want to try credit banking. They kind of dip their toe. They do a little bit, and there's some things to watch out for. So let's just jump right on in. And I'm going to illustrate or try to help you understand some of the concepts of business credit and credit banking and how they help each other out. So here's Max. He looks sad, doesn't he? Max, look at Max. Max, why is he called Max? Because he's been maxed out. Has anybody ever been there? Have you ever felt that way? You're maxed out or you've been maxed out? I mean, he owns his house, but for 2 years, his credit cards are maxed out. I mean, he's just at his limit. So we're using the numbers that Ray was working with you last week. And so imagine having 5 credit cards for a total limit of $15,000, but carrying a $12,000 balance. I mean, that's over 80% utilization right there. And then being in this situation, for 2 years. I mean, how did we get here? How does that happen? Well, it happens a lot of ways. I mean, life happens. I mean, anytime your expenses for an emergency or a situation exceeds your monthly income, people, they put it on credit. And that helps in the short term, but in the long term, it creates a payment. And if you couldn't afford it to begin with, if you couldn't afford the full amount, then the monthly payment that comes with the credit, you can't afford that either. So more money ends up going onto the line of credit and it begins to snowball. Now, I want to also talk to another group of folks who end up in a situation where they're maxed out, and it's because they are business owners. Maybe you're the pool cleaning guy, or you paint, nails, or you do hair, or you have any number of businesses where either you're self-employed or you actually own a business and you have employees. But here's what happens. So many of you used your personal credit to fuel the business. I mean, come on, you got to admit it. You did. You used your personal credit or your credit cards to purchase some inventory, to get some machinery up and running, to maybe purchase some advertising, all the different things that go into setting up a business, the office, everything from even paying the taxes, payroll, all of it. Everything that goes into running a small business, it can be very costly. And so early on, when you don't have any cash flow coming in, it's easy to put that on your personal credit cards. And before you know it, you're maxed out. Then what, right? So business credit is one of the areas that business owners seek to try to get access to more liquidity because it takes money to make money. That seems pretty simple. But we're also talking, and the focus of tonight is credit banking. But here we're going into some advanced strategies. So, and when I say advanced, keep in mind, when I say advanced, this isn't like where you should be thinking, oh, I want to start right here. Once you once you have a good grasp and understand how basic credit banking strategies work, velocity banking, cash flow banking, mortgage sweep strategies, all these different things, if once you understand the basics, and then you're ready to move to different types of strategies. So we talked about using a HELOC. You're able to pay down the debt on your house and you get at least 40% equity or more in your property, you begin to become eligible for what's called a first position HELOC. Now, if you go to a traditional lender to try and get that HELOC, a lot of times they're going to tell you no. I mean, if the big bank, you know, they're all out there, Chase, Wells Fargo, Bank of America, all of those, if they own the first position, then they'll likely give you a second position, second mortgage HELOC. But that's not what we're interested in. We're not interested in that. What we're talking about for an advanced credit banking strategy is getting access to a first position home equity line of credit. How do you do that? Well, a lot of times you have to go look at the smaller banks, maybe a regional bank or a credit union that will offer you favorable terms. And what they're looking for is how much equity do you have in your home? What is your income to debt ratio, right? They're going to be looking at your credit utilization. They're going to be looking at your full financial picture. So when you go for the HELOC, if you meet all the criteria that they're looking for, then what they do is the bank will pay off the first mortgage, the bank that holds that. And then, of course, a HELOC will be somewhere around, let's be conservative, 70% loan to value. So if your house is worth $100,000, you could get a HELOC for $70,000. Now, are there banks that'll give you 80% loan to value, 90% loan to value? Yes, they do exist. They are out there. But you've really got to have strong financials to qualify for a higher loan to value to get better terms. Because, well, let's face it. I mean, if the more risk you are, then the harder, or the shorter your term is going to be, the higher your interest rate, the less amount they're going to let you borrow. I mean, any number of factors can affect this. But best case scenario, if your financials are strong, your credit score is strong, your utilization's low, your debt to income ratio is low, then you're going to qualify for a HELOC in first position, maybe at 90% loan to value. But let's talk about, let's be conservative. And let's use numbers that make math a little bit easy on the brain. If your house is worth $100,000 and you have at least 40% equity in your home, that means that the amount that you owe would be $60,000. So if a bank is willing to give you a $70,000 home equity line of credit in first position, that means they'll pay off the $60,000 you own. And then you've got your $70,000 home equity line of credit, but they put $60,000 on that line, leaving you a gap of about $10,000 to work with in that line of credit. Now, if you use your credit banking strategy to aggressively pay down that debt, then once you've paid off that house, you still have access to a $70,000 line of credit. That's what's amazing. And that's what we want to use, because sometimes your interest rates could be as low as 4 or 5%, or maybe depending on, what your financials are, it'd be 9%, maybe even as high as 12%. But that's all going to be simple interest, and it's going to be amortized in a very inexpensive way based off of an APR. So we like home equity line of credit. Now, a question came in here on the chat. Let's see what we have here. If you don't have any equity in your house, what if you don't have any equity in your house? Well, if you don't have any equity in your house, then you're not going to be able to get a home equity line of credit. But if you don't have any equity in your house, there are other ways to get access to lines of credit, which is why we introduced and we're introducing to you the concept of business credit. Now, some of you are like, what is business credit? Well, by the name, it's credit that your business can get. It's credit that your business gets. And we can go over that, and we will go over that on the slide. But in general, you're trying to get credit for your business that's separate from you personally. And if you're like, well, I don't even have a business. Well, let's talk about why you might want to think about starting a business. All right, especially if you have a house with no equity in it. Getting a business line of credit or a business credit card or even a business loan are all excellent ways to access cash that you can use. Now, if we're talking about business and personal, one of the things that's really that you don't want to do is you don't want to commingle funds. However, most people like Max here, how did they get in the situation? Well, if they were a business owner, they used their personal credit to fuel the business. So if we can get them some business credit, we can transfer balances from those personal cards to the business cards because they were initially used for the business anyway. So, and then if you're in a situation where you don't have a business and you don't have any business expenses, but you're maxed out and you start a business, well, maybe you need to look at what can your business start to purchase that can start alleviating some of your debt. Can your business purchase your car from you and take over your car payments? Sure. Could your business purchase your house? Yes, it can. I mean, all of these things can really help you in terms of alleviating your income to debt ratio, high utilization, low credit scores. So let's take a look. So here we are with Max. He's been maxed out for 2 years. And let's say he's got 3 credit cards, each with a $5,000 limit, but he's carrying a $3,000 balance. Or I'm sorry, that's not what's happening here. He actually has $5,000 of income that's coming in, and he has $3,000 of monthly expenses. So his cash flow is whatever you have that's left over after all monthly expenses have been paid. So his cash flow is at $2,000. Okay, now look at this. If we have 3 credit cards and they each have $5,000 as the limit, then that would, if 5, 10, 15, that would equal a $15,000 limit. Now, if we're carrying a $12,000 balance and it's equal amongst all 3 cards, that would be having a $4,000 balance. So let's take a look at that. So Max, he's maxed out, and because he's been maxed out, his credit score is low, right? Because his debt to income ratio is high. He's got so much debt, and a lot of his income goes to servicing his debt. And his credit utilization is high. It's over 80%. So we talked about just one of his credit cards. He has a $5,000 limit, but he's carrying a $4,000 balance. Now he's seen some videos on how to do velocity banking, credit banking, mortgage sweep strategies, cash flow banking. It goes by a lot of names, folks. So he thinks, well, I'll do that. I'll go ahead and I'll take my income and I'll put it on my my credit card. I'll just go ahead and pay that card down to 0. And you're like, yeah. But here's the problem. If you've been maxed out, if your utilization has been over 50% for more than 6 months, then the bank has the option to lower your limit. In this case, if he's been maxed out he's been over 50% utilization for 2 years. So as soon as he pays down that balance, look what happened to his limit. He paid $4,000 off on the credit card. Woohoo. But then they dropped his limit by $4,000. Like, now he's feeling trapped. Wait a minute, this doesn't work. Credit banking, velocity banking, this stuff doesn't work because I just paid off the card, but now I don't have access to the credit. So now he feels stuck. Then he has a few choice words for Joseph. He's like, hey, this doesn't work. You don't know what you're talking about. Okay, well, yeah, you got to keep in mind that when you watch a video on YouTube, it's usually not a good idea to just run out and try it on your own. You need to make sure you're talking with the professionals in your life to make sure that when you implement these strategies, they work for you, especially in your specific situation. So if you have a credit card that's been over 50% utilization for more than 6 months, and the longer it's been over 50% utilization, the more likely it is that the credit issuer will lower your limit. So in this case, he's been maxed out for over 2 years. So they're dropping his limit because he has to start showing them that he can be responsible with his credit. Instead of being maxed out all the time, they want to see that he can utilize his credit wisely. And how do you do that? Well, you don't want to go over 50% utilization. Actually, what they would really like to see is you keep it under 30% utilization. So, but these are things that Max, he didn't know. I mean, what class in school was it where they taught you utilization of credit cards and how to appropriately manage your credit? I don't know what class that was. I mean, they don't teach that stuff. And isn't that a crying shame? Because how many people get right out of high school, go into college, and they get their first, credit card? It's like giving a little kid matches to play with. If you don't know what you're doing with this tool, you can really hurt yourself. So Max is feeling really frustrated because this isn't working for him. This situation, he's watched other people. He's been on YouTube and he's seen other people are chiming in. Yeah, this really works and it's working. And I've already paid down a lot. But it didn't work for Max because in his situation, he's been maxed out for too long. And, that happens to folks. So why are we talking about business credit? We're talking about business credit because we're going to look at one of many strategies, advanced strategies, to use your business credit with credit banking. The two create a synergy for each other. So Max, especially if Max has a business, but if Max is in this situation, he might be a little cash strapped and it might be difficult for him to start a business, which is why, he probably shouldn't. Again, this is an advanced strategy. For those of you who already have a business, or maybe you live in a state where it's very inexpensive for you to start a business, then you should consider this, because starting a business and having a successful business is determined by 3 things that you see on your screen. Right there on the right of your screen, you see it takes cash flow, credit, and collateral. Every successful business has cash flow coming in, has credit, and has collateral. Now, a business that's just brand new, just starting, doesn't have any of that. Now, this is what we need to do. We can use credit banking strategies combined with business credit, and we can help each other out. So how do we do that? Well, we have to start by building business credit. Business credit is built off of the EIN number for a business. That's the employer identification number. It's the tax ID that the IRS issues to a business. And then when Max, as an individual, his tax ID number is his social security number. So when it comes time for him to do his taxes, he fills out his forms with his social security number. So you build your personal credit is all based off of your social security number. If you went to go to Credit Karma or something like that to check your credit score, Credit Sesame, any of those places, they're going to need your social security number. And then you have to verify that you are who you say you are, and then you can see your credit score. Well, with a business, it's not the social security number that you build the credit with, it's on the EIN number. And here's a great thing. Business credit, totally different from personal credit. And personal credit, it could take you a lifetime if you make one mistake, if you go to collections, if you have bankruptcy or foreclosure, it could take years for you to fix that. But with business credit, you can build an excellent business credit rating in as little as 6 to 12 months. And along the way, what you do is you're able to get $50,000 in lines of credit. That comes in the form of vendor credit, store credit, fuel credit, cash credit, all different types of credit, your business uses. And that's just in your first 6 to 12 months. After that, you can build an additional $150,000, $250,000 in credit based off of what your business actually does. Thank you for the water, Ray. So here's what we're going to do. Here's one possible strategy. So with business credit, there's a lot of things you could do. If you have $50,000 in lines of credit, let's say we take $25,000 of the corporate credit cards at 0% interest for 24 months, very standard, very common for businesses. You could give a loan to yourself on the personal side. Businesses give out loans all the time. You can give out loan money to yourself personally, pay off debts if you needed to, and then you pay your business back. You could set up any kind of note. Now, typically when you lend money to yourself and you pay yourself back, that doesn't really count as, from the business's perspective, that doesn't really count as having actual establishing business credit. But it can be a very easy, very quick way for your business to bail out your personal side. Now, if you have some kind of crazy idea that you could build business credit, transfer your personal debt to your business, and then just let the business go, it doesn't work that way. Because if the business if the business can't pay its bills, then a bankruptcy court or even the credit issuers are going to untie the debt that was to the business and reapply it back to you personally. So this is everything that we're trying to teach you and show you is things that are completely ethical and above board, and we want to have full disclosure to all parties as required by law. So if we are going to lend money, we want to document it. We want to actually create a note, a private note, and then pay that back. And then you would need to have the proper accounting to show that the payments are being made. So one very simple way is you can give your business can give you a loan. It's very easy to pay back a loan, very simple. You set the payments. Now, you can also extend to yourself a line of credit. Couple of ways to do that. Your business, right? You got your corporate credit cards. You can actually have, you can ask for an additional account and have another card for your business that's extended to you personally. It's like if you have a credit card and you wanted to give it to your kids, maybe they were going to go do some clothes shopping or something, and so you gave them one of, but not your card, but you gave them a specific card, and then you control the limits on how that card's going to be used. That's one way, of course. And then what you see on your screen is I kind of have a little bit of a creative way to do this, but again, it's complex. And I want you to know that to put this together, I had to have an accountant, and there's a lot of moving pieces here. But I just want to show you something that's possible. If I couldn't qualify for a HELOC through a bank because I don't have enough equity, because maybe my credit score, my debt to income ratio, or my utilization are not where the bank wants it to be, I can have my business extend a loan to my personal side, right? And so Max has a house, but we're going to call this what I call a HELOC, a business home equity line of credit. The business is going to extend a home equity line of credit. Now, there's a lot of ways you can do this because you want to make sure that you have a lot of reporting. You want to keep all parties notified. But if you are going to put and record a lien against the property, it's best to do that with the county, to record that at the county. And you can actually contact a title company, and they can do it for you, or you can fill out the paperwork and go to the county recorder's office and do it yourself. But what you're looking to do is just set up a note, and you can set up the note and you can come up with all kinds of terms. You can have deferred payments, you can set different interest rates, you can have interest only. There's all kinds of notes that you can set up. But the important thing is that, so we're taking $25,000 in corporate credit cards, and we're putting that as a lien against the property. And we're going to file this lien. We're going through the title company. So the title company will file that with the county. And so now there'll be a lien. And so also with the lien will be the private mortgage note that explains the terms of which the money is to be repaid. Let's say a 2-year maybe 30% interest only payment, and it's going to be in a second lien position because remember, Max still has his first mortgage with his lender, with his bank. So maybe the payment comes out to $500. So how does this work? Well, before Max, instead of putting money onto the credit card, which we know isn't going to work, right? Because he's already been maxed out, over 50% utilization for over 2 years. So now what he's going to do is he's going to take his income and he's going to, even though he's got only a $500 payment, he's going to put all $5,000 onto the line of credit. Now, it could be he has deferred payments. I mean, there could be a number of things that come up. But when you put $5,000 onto the line of credit, the title company is going to, if you're running through the title company, if you set up a loan and you have the title company can service that loan if you want. So then you have a minimum payment for the loan, but you overpay it. And so the title company takes out its processing fee and then puts the rest of it. Let's say it's taking out $50 to process this payment. The rest, $4,950, goes to the business. Now that, I'm going to turn my video off because I'm going to start using that side of the screen. So as you see, so now you have revenue coming into the business. This is not considered income though, because this is repayment of the loan. So that's important to keep in mind because as you have an accountant, you got to account for everything here. So, but you do have revenue coming in, gross revenue. And there are a lot of revenue-based type of loans. There's merchant cash advances, there's what are called merchant lines of credit, and there's merchant loans that are all based off of the criteria of how much cash flow that you have coming in. And so, and they base that off of your bank statements. How many deposits, what's your average daily balance, how many NSF fees do you have? So right now, we are showing $4,950 coming in every month in just gross revenue. Now, all of that, except for the interest is the actual income, but the rest of that is loan repayment. And I have to stress that if you're going to do a strategy like this, that you do get an accountant. You've got to keep track of all of this because could you imagine getting audited by the IRS and then trying to explain how what all of this is? This is very convoluted looking. But if you have an accountant that has a ledger that itemizes out everything and shows exactly what's loan repayment, what's interest income, then everything will be fine. So, but what is, we're trying to build up our business. We're trying to establish our business. And so one of the very first things that our business needs is cash flow. At the same time, Max, he got himself $25,000 in a loan. So what can he do with that? Well, he owes money on his vehicles, and he can pay off his credit card balances, and he still has enough money to pay off his car, right? So he immediately is benefiting from borrowing this money. So let's take a look at that 25,000. So the way that works is he's going to continue to utilize this $25,000 on these corporate credit cards. So how does that work? Well, every month when he has his $3,000 of expenses, he puts that on the corporate credit card. And every month he takes his $5,000 and he pays that to the title company that services the note for the business. So the business has $4,950 that comes in, and it applies it to the debt, which brings the debt down every month. And then, of course, as the card's utilized, more expenses are put down. But here's what happens: if you follow the math that we're seeing here, this gets paid off in about 11 months. In 11 months. Now, keep in mind, this is a corporate credit card with 0% interest for 24 months. And so it's been paid off in 11 months. So at this point, you could completely pay off the note and then it's all done and the second mortgage is paid off. Or what can you do is you could reestablish the note again for another 25,000, right? Because you have 24 months to work with. So you could either set it up at the beginning for a $50,000 note, or you could set it up, as a $25,000 note that you pay off and then reestablish it. Again, it's going to depend on how are you doing this as a loan? Are you doing this as a line of credit? There's a lot more accounting that has to be done with a line of credit because we don't want to claim any of the expenses as business expenses because they're associated with the line of credit. So this does get a little complicated because that's all going to be part of the line of credit that's been established. And so as it's paid back, as the money comes in, the business can't claim any of those expenses. All right. So as it gets paid down, so let's say that if you want to do it again for another 25,000, you can take a huge chunk out of what Max owes on the house. And so now in another 11 months, he's totally paid off the $25,000. And in doing this, over this period of time, these corporate credit cards that are being used every month, and the great thing about credit is if you put a balance on a card and then you pay it down more every month than what you use it for, right? Your balance, you put a balance on a card, but then you're paying it down more than you use it every month, right? If you do that, what happens is about every 6 months, you can apply for a credit limit increase. You can either, especially on business credit, it doesn't really have an impact to your personal credit. So it's not like there's an inquiry or a hard pull. But every 6 months on your corporate credit cards, you should be asking for a credit limit increase because you're using it the right way, and they can see that and track that. And so within 6 to 12, 18, 24 months, it is possible to grow that $25,000 corporate credit cards into as much as or up to $150,000. That is the total amount that's possible. Is that what everybody does? No, but I mean, you will grow the lines of credit if they're used the right way. And this is one of the right ways to use them, where you put a balance on there and you pay it down more than what you use it every month. And so in doing so, your business has done something very important here. It has now established its credit. It's grown its credit, right? By using the credit and you continue to use the credit, you're establishing a payment history for this business. So now you're growing your business credit. So let's say we've grown it by the max, $150,000 now. Well, this is pretty awesome. So let's also take a look at one other aspect. Look at this private mortgage note that's in second position. This represents equitable interest in an actual tangible asset, a house. Now, if there is equity in the house to cover the note, then you actually have collateralized the note. If this is in excess of what you owe, meaning there is no actual equity in the house, well, then this note actually isn't collateralized. But keep in mind that if the money that's being borrowed is going to pay down the principal balance, what if you take two different chunks and take $50,000 off of the total amount owed on the house? Well, then you've created the equity position right there just by how you utilized the credit and paid it off. So either way, you end up creating collateral for your business. So now we have cash flow, credit, and collateral for our business. We've now made our business more credible, more lendable, more fundable. So when our business looks to get other different types of loans or lines of credit or corporate credit cards, we now have a very positive business credit profile to show. And all we've done is taken a business and utilized it to help us do credit banking on Max's personal side. So the business has benefited fabulously. Look, it has cash flow, it has credit, it has collateral. It's doing very well for itself. And then look at the benefit that Max got. See, he's happy now because we paid off those credit cards, so the utilization went down. And by eliminating the auto loan and by bringing down the debt on the house, his debt to income ratio has gone down. When your utilization goes down and your debt to income ratio is going down, this is having a positive impact on Max's credit score. His credit score is going up because of his utilizations going down. So Max is in a better position. 2 years later, Max is way better off than he was before. Now, with his personal credit over these 2 years, let's hope that he's made some purchases and paid them off, made some purchases and paid them off. He can grow those lines of credit back up to where they need to be or where they were before in the past. But instead of Max applying for any new personal credit, here's the great thing is now your business credit has grown from $50,000 in lines of credit to now $150,000 in line of credit. But because Max was able to use the business to help him on his personal side, well, now he has a good enough credit where he can go give a personal guarantee to his business. He can personally guarantee maybe 5 more corporate credit cards, totaling up to as much as $150,000. Again, that's going to be dependent on his debt to income ratio, his utilization, his credit score. So there's a lot of factors that go into how much you can personally guarantee. But what have we done? We have totally improved Max's personal financial picture by utilizing business credit with credit banking. And what does that do for the business? Well, the business had $150,000 over 2 years that it built up in business credit. Now it gets an additional, doubles its corporate credit, because now they'll have access to an additional $150,000 after the personal guarantee, giving the business $300,000. Now, what could the business do with that? Well, there's a lot that the business could do. What if the business chose to buy Max's house? What would happen to Max's debt to income ratio if the house wasn't on his wasn't a factor in his debt? And then some of you be like, well, what about the mortgage interest rate? Is he giving that up? Well, folks, you're getting a lot of benefits here. But if the business owned Max's house outright, well, the business can use that as a tax deduction, a write-off. It's an office now, and Max, uses the office. But here's another thing is you can, with business credit, you can apply for what's called a non-recourse commercial collateral loan. Again, that's when you start taking different, maybe if you bundle 5 houses or more together, but you can collateralize different real estate assets. So with a personal residence, if you live there and you're willing to give the personal guarantee, then you can get a type of a HELOC. Even though the business owns the house, it's not going to be called a HELOC, but that's something to consider. Maybe you want to keep the house in the personal name, but have the business take over the debt. You could in some ways do what's called a subject to, selling the house subject to the current financing that's in place. And there's a lot of different creative strategies, but when your business has access to $300,000 in corporate lines of credit, you could invest in real estate. You could invest in all kinds of things. Well, I mean, what is your dream? What did God put you on this earth to do? And is there a business that's on your mind and your heart? Did you want to start a family restaurant? Did you ever have this dream that one day, like grandma and grandpa, mom and dad, brother and sister, and the kids would all work at a family in the family business? Whatever it is, you now have the credit and the cash to be able to fuel and fund your dreams. And I mean, that's what we're really talking about. Yeah, we're talking about credit banking and getting out of debt. But if you're really wanting to use advanced strategies, you've got to be thinking forward, because at some point you're going to be out of debt, right? Your goal, I mean, a lot of us make our goal, I just want to get out of debt. But think about that. You're in the negative and you're setting your goal to eventually get back to zero. I mean, what kind of goal is that? Yes, I'm at zero. No, you've got to have another component to your dream. Yes, getting out of debt is great, but then what are you going to do? If you don't have a plan for what you're going to do, you're going to go from zero right back into debt again. So you need to have a plan for what are you going to do with your life? What is your purpose? What is the legacy you want to leave behind for your loved ones? And so you start creating the type of retirement that you want. You learn how to invest. And there's all different ways you can do that. I personally invest in real estate. I think it's one of the best ways to invest, but you've got to have a plan. And whatever that is, whatever you're inspired to do, whatever you were put here to do, that's what you need to do. And that's why I love credit banking, because it eliminates the debt. But when we combine it with business credit, it now gives us the ability to fuel our dreams. So I wanted to show you this strategy. There's also the HELOC strategy, a lot of different advanced strategies that we use that we help a lot of our clients with, because everybody gets into Max's position one way or another. And sometimes we just can't access credit. We just don't have the ability. We can try and do a secured line of credit strategy, could try and see if we can qualify for a home equity line of credit. But I want you to know that there's another possibility. You could start a business and very modestly build that business. And maybe the business is, what are you in business for? Your sole business is to promote the general welfare of your family, right? I mean, that could be what the business is there. The business is there to help you create an extra stream of income that enables you to retire one day so you don't work until you die. Unless you enjoy what you do, and then you never actually work a day in your life. But I wanted to show you this. And so let's go ahead and now switch gears. This slide here is to show you that there is a way where you can, this is using QuickBooks, account for all the interest income that comes in, the title company payments. If you do this as a line of credit, you've got to account for the payments and the interest income. So you definitely want to make sure that if you are going to utilize some type of creative business HELOC strategy, right, that you have an accountant and that you keep really good books. Okay, I want to switch gears here real quick. Let's get into the mastermind side. I love this point in the call, and I really want everybody to participate. This isn't for me to just give you all the answers. That's not what I'm interested for. I really want you to feel like you're progressing in your knowledge. I want everybody to learn this and start to master it. So what I have shared on the screen here is real life numbers of somebody's finances. And so we're just going to take a look and see what should we do, what can be done. So we got income, we got expenses, we got available credit, we've got the credit balance, we've got the interest rate that they have on, and that interest rate goes with the credit cards. But then they've got a loan amount, certain term to that loan, where we're at in the loan, the interest rate, the payment. So let's go ahead and take a look. So first things first, we look at the income. We have $2,000 a month coming in. Okay. And then we have $1,800 worth of expenses. So who in my math geniuses can tell me what is the cash flow here, right? What's the cash flow? If we're doing a budget, and this is stuff, and especially what we're going to work on next week, we need to figure out what are all our sources of income, right? And we need to identify what all of our expenses are, see if there's any duplicates, and then make adjustments. So Billy Flowers writes $200 of cash flow. Yes, that's absolutely right. We have $200 of cash flow. So that's how much is left over after all the expenses are paid. Now, let's take a look. So we have in this example, we have $3,500 of available credit. Now, of the available credit, we are carrying a balance of $3,500. So what is the percentage of utilization? Okay, so we have one credit card, two credit cards. Okay, so we have somebody here in the webinar saying, let's see, we're right. Good job, Kareem. I think that's, yeah, Kareem. Kareem says we're at 100% utilization. Good job. Excellent, excellent. So 100% utilization. And Billy got it too. Good job. All right, so we're at 100% utilization. So, and look at this interest rate on this credit card, 27%. Now, the national average is 21%. So this is a pretty high interest rate on this credit card. Okay, so immediately I start looking at this, and then, okay, so I want you to know, so when numbers are shared with me, I don't always know what somebody's trying to share. So loan amount. So the loan amount that they put here is $100,000. And then they show that it's a 30-year loan that started on October 19th, 2004. Well, as I look at this, if it was $100,000 back in 2004, and they've made all of their payments on a 30-year amortization schedule, then today they would owe $74,506.90. However, if that's the case, then the month payment would be closer to $700 than it would be $1,000. And so there's a number of different things to explain that. Sometimes people have mortgage insurance, or they hold out their taxes, or sometimes people just make extra payments towards the principal. So that could be the case here. Or the amount that was listed here, the $100,000, is actually the current balance and not the original balance. So the question, as it was asked on the form, is what was the original balance? But you know, a lot of people put what the current balance is. So if the current balance is $100,000, and they have and the loan started on October 19th, 2004, and it's at 7% interest, then the payment is closer to $1,000, right? So these are just things that I have, that I take a look at, and I try to understand. Sometimes when people, when they submit their entries, they type out their current situation. It gives me some insight, and I better understand these numbers. But in this case, we didn't get any additional information. So at this point, you know now as much as I know. What would you do? What's the first thing that you would do? What would be your plan? That's what the mastermind's about, folks. Is let's consider some options here. What could we do here? Does anybody have any ideas? Excuse me while I take a drink of water. Okay. So I have a number of thoughts. Oh, but we have somebody coming in off of the chat. So let's see what we have here. We have somebody say, Pat says refinance. Refinance. You know what? That might not be a bad option here. We're at 7.5% interest. We probably, didn't they just lower the interest rates today? Didn't the Fed just lowered the interest rates today? So if we refinanced and we qualified, which if we made all our payments on time, probably going to qualify, we could get a lower interest rate. Again, we'll lose. Look at how far we're into this. We're into this 16 years. We're 16 years into this loan. So you'd have to give up 16 years worth of equity that you've gained just to lower the payment. And then you start all those interest payments over again. But maybe the interest rate, I mean, what would it change to? 4.5, maybe 5%? You know, that a lot of people consider that as an option. I wouldn't do that personally, but I mean, a lot of people think that that's a good way to go. But you have 16 years and a 30, you're already past the halfway point. So refinancing means you're giving up, you know, 16 years worth of equity that you've been building up. So that might be more expensive than what it's worth. But again, refinancing can work if it makes sense. So we have Phil Davin say, you know, hey, make an extra payment. And you know what? Making an extra payment could work here, but we're limited by this $2,000 a month income. So the only extra payment that could be made is this $200. But you know, that's not a bad idea either. So we have another thing coming in off of the put $2,000 income in the credit card. So that is an outstanding idea. So if we were to start, thank you, Kareem. If we were to start taking the income and pushing it through this line of credit, it would be paid down every month by $200. So you could get your credit card balance eliminated in 18 months. So 18 months puts your credit card balance down at zero. Now, Billy Flowers says, put the income into the credit card and pay expenses through it. Hopefully it hasn't been maxed out for more than 6 months. Hey, Billy, good job paying attention. Yeah, when I see 100% utilization, I guarantee you the first question I'm asking is, how long has it been that way? Did you just make a recent purchase? And, you know, if the case is, yeah, I just had to do an auto repair just last month, then I'm like, oh, okay. Well, then let's get that paid down as quickly as possible. So yeah, but at $200 cash flow, it's going to take 18 months, actually 17 and a half months, but I'm rounding up. But it's going to take a year and a half just to get that balance down to zero using basic credit banking methods. We need to also consider the possibility, I think, I'm going to throw my 2 cents in here. We need to look at a way to increase this income, folks. I don't know the job that's being worked here, the hours that's going in, but maybe there's a possibility of supplementing the income, driving some Uber Eats, maybe depending on where this person lives, if they own their own home, they could rent out a room, do some Airbnb, there's a number of ways to start supplementing your income. There's a lot of referral-based income that's out there. In my line of work with real estate investing, if you can find me people, property, or money, that could put a couple $1,000s a month in your pocket. So, but I mean, it just depends on where somebody's at and what they can do and the resources that they have. But I would consider increasing the income as a possibility. If your job gives you the opportunity to work a little overtime, or if you're, maybe you don't, I hate my job, I don't want to do that. Well, then look at other ways to supplement that income. If you're single, maybe it's time to get married. I'm just playing around, folks, but you got to look at ways to increase the income. A lot of our first thought always goes to, well, how can we reduce expenses? Let's cut expenses. Well, we do need to look at that. Are there areas where maybe we're eating out too much, or we're duplicating things? We've got Netflix and Amazon Prime and Hulu, and we've got Disney Plus. We got all these different things. Maybe we just need to pick one, right, and eliminate some expenses. But ultimately, even if $1,800 in monthly expenses, that seems pretty own bear. I don't know how much more they could cut back from that. So you really want to up your income. That would be the first thing that I would start thinking. So we have Kareem say, if credit isn't shot, try to get a higher credit source, new line of credit. Absolutely. We don't know anything about this person's credit score other than their utilization is really high. So if the utilization is that high, then we take a look at, well, so $3,500 is the limit, and what we need to get it down to is about 1,050, right? So if I take 3,500 and I minus 1,050, right? That means I need to pay my card down by $2,450. Well, if I divide that by my monthly cash flow of $200, in 1 year, a little over 1 year, I can get down to 30% utilization. And then you're right, I could apply for a credit limit increase, right? I could apply for another line of credit. Also, there are other ways, other people can co-sign on a loan, can co-sign on a credit card. There's other ways to get access to more credit. So I do like that. Again, but people are like, oh, I don't want to borrow money from family or friends. I don't want you to borrow money from family or friends either, especially if I'm your family or if I'm your friend, right? What I want you to do is I want you to learn how to add value to other people's lives. And sometimes, one of the best ways to do that is to start a business. Start a business that produces or creates some value for somebody, and then have somebody invest in you or invest in your business or pay you for your services, right? Then you supplement your income that way. But again, we're going to have to work with what we got here. So let's go ahead and now go over to our handy dandy credit banking calculator. Let's see, here we are, credit banking calculator. All right, so here's what we're going to do. We're going to take this calculator and we're going to plug our numbers in. All right, so let's go over here. And so our credit interest rate is 7% interest. Yikes, that is a lot. Our income is $2,000 a month, and our expenses are $1,800. Okay, so now we've got our income established here. Let's go over and set the parameters for our loan. So let's go with the numbers that they give us. So we have $100,000 at 7.5% interest, and there's 176 payments left, and so that means that they're showing the payment to be roughly around $938.46. So this person could have an HOA fee tacked in there. They could be setting aside money for the taxes, and that rounds it all up to $1,000, or they just round it up to $1,000. But let's take a look. Let's take a look. Let's see what we can see. So if we do nothing and we stay the course, this will be paid off in 14.76 or 14 2/3 years. Okay. Now, if we had the ability to make an extra $500 a month payment, this thing would get paid off faster than what we're doing with credit banking because we're only working with $200 of cash flow. But I want to show you something. Let's adjust the payment. What if instead of doing credit banking, we just put the extra $200 towards principal each month? Well, look at this. We're going to actually pay off the house faster, right? In 10 years and 10 2/3 years, right? And we're going to save ourselves $19,667 in interest. But look, with the basic credit banking method, we're going to pay it off in 10.92 years and only save us $16,647. Now you're like, well, wow, how come that's the case? Well, it's because look at the interest rate. This is 27% interest rate. When we break that down into an APR, that's like 2.25% interest that's being paid every month. So you have to take 2.25% of your $200 that's going to pay that interest. Whereas if you just took the $200 of cash flow without, throwing it through the credit banking method, then you're going to be better off in this case, right? Not by much, but still, that's something to consider. Hey, this is a mastermind. I just want to show you different ways to look at stuff. Now, if we have, this person has equity in their house. If you've been paying, I don't know what the original loan amount was, and so that's why I can't figure it all out. But this person's got equity if they've been in this loan for 16 years, right? So because they have equity in this house, they might want to look at getting potentially either a second position mortgage, if that makes sense. I don't know if they have 40% equity at this point or not. So they might want to, if they did, they could look at getting a first position HELOC. So again, but they still have to get that debt paid down. The utilization on their credit card is a little too high. Income to debt ratio is pretty high with only $200 cash flow. So they might not qualify for the best HELOC out there, but they might be able to get better terms on a second position HELOC. And then that would give them access to a greater line of credit. Again, there's just, we don't have enough of the picture to know everything faux show. But these are just some ideas in the mastermind. Anybody else have some ideas that they want to share? So I was talking about increasing income, right? This is, definitely there's so many different ways, but we want to either increase income. I don't know that we can really do much with the expenses. $1,800 monthly expenses, that's pretty good. But if we can increase income, then we can increase the cash flow. Utilization, we need to immediately address utilization. Regardless of what strategy we're going to do, we need to bring that down. And then somebody talked about refi. Well, refi would get you a lower monthly payment and a lower interest rate, but what do you trade off? You trade off your equity. It would help if we knew what the original amount of the loan was, so we knew how much equity we had. But I've got to imagine 16 years into a loan, we've got a significant amount of equity. All right, so we have here, Lady Love, where do I get a credit banking calculator? Oh, that's a great question. Normally what we do is we have our clients click their heels together 3 times and say, there's no place like home. There's nothing like a credit banking calculator. No, hey, I want to show you. You want to know how to get a credit banking calculator? I'll show you. If you can see my screen. Hey, you go to the Wise Guys and Ties website. Take a look at this. How cool is this? So what am I going to do? I'm going to do / and type in the word credit, and then put in a hyphen, and then the word banking, and click enter. Bam, look what we got here. I sign up for the weekly group webinar, right? You put all your information in here, check mark off the boxes. That's all that's required. And then you'll get the link to the weekly webinars, and you'll get reminder emails. It's great. And if you want to consult with us, you then can choose to fill out this information. If you like the mastermind that we did today and you're like, hey, I'd like you to go over my numbers, well, fill this out. But if you just want the credit banking calculator, you can skip all of that, come down to the current situation down here and say, I would like the credit banking calculator. Make sure you say please, PLEASE, right? The magic word. And then click submit, right? Of course, you have to put your name, your email address, your phone number, check mark the 4 boxes. Say you want the credit banking calculator, and we'll go ahead and email that right to you. Now, when you put your information in there, I want you to know that we don't contact you unless you want us to contact you. All right, you have to notify us that you want us to contact you, and then we'll contact you. And I don't sell your information. This is just for my purposes. And we keep everything confidential and private. We never share anybody's information on any of our webinars. But again, if you want that, if you would like a copy of my credit banking calculator, I want you to know, use at your own risk. It's just my crazy, formulas in an Excel spreadsheet. But I also want you to know something here. This is something very important. Let's take a look at the spreadsheet here, because it goes over basic credit banking, and it also will show you some advanced credit banking strategies, because if you have the ability to get a HELOC, you can put your HELOC numbers and everything in here. But here's two things that's very important that we do when we look at this stuff. We are assuming when we look at this that your income is not going to change. Look, we're talking about 14 years, 10 years, 10 years. Okay. Now, I don't know about you, but over the last 10 years, my income certainly changed. I mean, I used to make a little teeny bit of money, and I've been very blessed with my real estate investing and my business and my business partner. We've made a lot more money. So the amount of income that you make over a 10-year period of time, that's going to change. It's for some people, it's going to go down, and other people, it's going to go up. So, but when we show you this calculator, it's assuming that your income doesn't change. Second thing is it's assuming that your expenses don't change. Now, I don't know about you, but over the last 10 years, my wife and I, we added 2 more kids to the family. My expenses have gone up a lot more than where they were 10 years ago. So, and I love the fact that the expenses went up. I love my boys. But keep in mind that those are some assumptions that are made. So from a mathematical perspective, you have to see that, not everything is static, obviously. People have, sometimes you run into some windfalls, right? Some extra money comes in, a tax return, or you won the lottery, whatever happened. Sometimes people have dips in their income. Some maybe you work a seasonal type job, or sometimes there can be, depending on what's happening in your industry, a reduction in force or layoff. So those things unfortunately happen. So your expenses can go up or down. It really just depends. But that's one thing to take into account, that this is just a mathematical representation of what is possible. Now, you, considering you might want to run several different permutations here, changing the income and the expenses to see how things are working. But as you pay down your debt, right, you start with a basic credit banking strategy, but as you gain more equity in your home, if that's what we're paying down here, because you can use this for auto, student loans, whatever you want to use it for. But in the case of getting equity in your home, you can switch to an advanced credit banking strategy. Maybe you're going to use business credit, or maybe you're going to use a HELOC, a first position HELOC strategy, or some other strategy that increases the income or access to lines of credit. So again, when you're utilizing this program, you have to go into the guts of the program, and you have to make certain changes to your amortization schedules. Make sure that that all works. So I share all that with, because some people be like, well, I saw your calculator and it said I was supposed to pay everything off in 4 years, and it took me 6. Well, right, because there's certain assumptions that are made, and you need to know that. All right. So we have another question come in, and it says, please explain the advanced credit banking on the sheet. Oh, I just closed out the sheet. So Lex, the advanced credit banking is when you're able to utilize a home equity line of credit, or if you have a business line of credit, you have a large line of credit. Okay, so you now with more credit at a lower interest rate, you're able to now accelerate the pay down. So the model that's being shown on the screen, let's see if I can pull that back up real quick. Let me see if I can pull that back up here real quick. And pull up the credit banking calculator here. And we go into the summary page here. Okay, so you're looking at debt with advanced strategy. Well, if I had a home equity line of credit at 4% interest, then I'm able, I have to transfer the balance, and that refigures what my actual payment on the house is going to be. It's going to be similar, right? But I start looking, because now I'm going to start running all my income and everything through I'm going to start running it through my line of credit. Now, when I pick up a home equity line of credit, depending on how much extra I get in there, I could throw the car in there. I could throw some student loan debt in there. I could throw a lot of stuff into my HELOC. And so that might free up a lot extra cash flow from my monthly income, because now I'm not having to pay those debts individually anymore. They're now in my HELOC. And especially if some of those debts were at 5, 8, 10, 12, 20% interest, and I'm throwing them into a 4% HELOC, I'm saving money on the interest now. But I've also now I've freed up that monthly income. And so now, but I'm still using a credit banking strategy. So I'm pushing all my income through the line of credit while putting all of my expenses back on the line. But the way a line of credit is calculated through as an APR, you're able to still keep the payments fairly low. So it's an excellent strategy. And then, so he says, please explain the credit banking strategy. I've been going over your sheet, but on the advance, I don't see anywhere where I can put the chunk maybe in. Lex, but there's no place to input this amount. I don't understand. Okay. So your chunking method is really here with, on these screens where you start changing how much is being applied here. So, and see with advanced, so you're looking at your balances here and your rates. So the input screens are going to be more based off of,
oh, there it is. Go back to the previous screen.
Sorry, hold on.
It's the initial chunk.
There you go.
Chunk frequency, chunk amount.
Yeah, so you see in the yellow here, Lex, this is where you control how much you chunk, how often, and the amounts. So you can play around with these numbers to look at how you're going to do that. And then this will also change the amortization schedule that you see here. And then you can go ahead and play around with it. Okay, it's totally incumbent upon you to play around with that. All right. Well, we've reached the end of our time, folks. We had a lot of great participation. I'm really grateful to all of you for putting in all of this time. We have a question here. When I did the sheet, the savings with the basic was more than the advanced, and I paid more percentage with the advance. Yeah, I mean, like in the example we did today, it actually showed that amortized debt with extra payments paid off faster than with the credit banking because the interest rate was so high. But depending on how much are you putting into this line of credit? How much? I mean, there's a lot of factors here. I mean, if you're putting in a lot of extra, if you're just transferring the debt straight over from the loan into the line of credit at a lower interest rate, then you're going to be, you should be having a smaller payment, which means that increases your cash flow. So that helps you pay it down faster. But to be able to utilize the advanced credit banking strategy, you need more information. I don't go a lot into the advanced credit banking strategy because each one is as unique as the person who does it. So we need to understand what all of the debts are. What are we going to lump into here? And then that's going to free up a certain amount of cash flow. And then we have a certain interest rate. And then when we look at it, we can run several permutations, but sometimes you're going to find that you're, in some cases, depending on what this interest rate is going to be, you might find that your expenses get higher. And what that would mean is if you've got really low interest rates on some of your other debts, or the payment schedule is it has a low payment built into it, that sometimes it just depends. But on the amortized debt, it's usually always going to beat the blue one, because the blue one is if you just make the straight payments. So what you have to do, and when you're evaluating how you want to do credit banking, if you want to do basic credit banking or advanced credit banking, is what are your goals? If you're getting a HELOC and it's freeing up a lot of other debts for you, but you might increase your payment, but you've also, keep in mind, when you start putting debt into a home equity line of credit, that home equity line of credit does not count against your income to debt ratio. So a lot of people use that as a strategy to go out and get more credit. Because if the bank is looking at my income to debt ratio to qualify me, or a credit card company is looking at my, my utilization to determine if I'm eligible for more lines of credit, they're not going to, in certain models of what they look at, they're not going to look at your HELOC as part of the factor for determining your credit worthiness. So again, it depends on what your goal is. So in some cases, it makes more sense to put everything into the HELOC to gain access to greater lines of credit. I mean, some people can use that to get another house. Some people can use that to get another vehicle or two vehicles. So again, it just depends. So last question we have here. Oh, not even a question. It's just Phil Davin saying thank you. I want to thank everybody. I want to thank Lex. I want to thank all the folks here. Pat, we've had so many great, Kareem, we've had so many great contributions from everybody here tonight. Thank you so much. We want you to stay tuned. Make sure you're registering with us to take advantage of these webinars, right? These webinars are for you folks. We love you. We want to make sure that you are able to, I mean, why do we do this? We do this because if we can help you eliminate your debt and free up your cash flow, then you'll be able to do what God put you on this earth to do. And for some of you, that might mean we might end up working together. I mean, you never know. But we also want you to stay tuned with us. Every week, we also put on business credit webinars at lunchtime at noon Pacific Standard Time. So that's this Thursday. And we also want you to know that you can go on our website and check out any of our upcoming events. Just click on the events tab right up here on our website. If you want to know when's that next webinar coming up, how to build business credit, how to get some direct funding, a credit banking mastermind, we always have the list of the upcoming webinar. When we're traveling and we're going out to our seminars, you can always find that information right here on our website. So folks, we want to help you achieve whatever your God-given purpose is here. And I want to thank you for being on this webinar tonight. And I look forward to working with you next week as we go over, well, the B word, budget. All right. Thank you so much, everybody. God bless you, and have a good night.